Stop. You do not want to file taxes for your business, your 1099 gig, or your side hustle without watching this full episode. You are about to find some of the biggest tax write-offs that you can use to literally reduce your taxes within a few minutes here. As a licensed CPA, I can tell you the number one reason why 90% of people overpay their taxes is because they miss one big thing: tax write-offs. I see it over and over again. There are things that you are probably already paying for, but simply not writing off. Like portions of your home expenses, car expenses, health expenses, your children, and so much more. And these are things that all can be legitimately written off through your business to help you pay less taxes. So as someone who helps people do this every day at mycpacoach.com, I want to share with you the top 15 tax write-offs that can help you save big money in taxes. So let's jump right in. All right, let's start by getting you an immediate 20% tax write-off against all of your business income with number one, the QBI deduction. Now, this is a freebie tax deduction that grants you a 20% write-off for simply being classified as a business owner, even if your trade or business is unincorporated. For example, someone with $100,000 in business income will be able to write off about $20,000 off of their income and only pay tax on the remaining $80,000, which would save someone almost $5,000 in taxes in a 24% tax bracket. Now, you can take this deduction as a S corporation, partnership, sole proprietorship, or as an LLC taxed as any one of those classifications. And guess what? You automatically qualify for this deduction if you earn less than about $192,000 as a single taxpayer or less than about $384,000 with a spouse. But this tax deduction is not automatically applied to your tax return. And I see so many people miss this easy tax write-off when they actually qualify for it. So make sure that you or your CPA does not miss this very easy write-off. Now, if you happen to earn above the threshold amounts that I just shared with you, then you may still qualify for this deduction, but there are some more strict requirements that relate to the type of trade or business you have as it relates to you qualifying for it. For example, certain service-based businesses do not qualify for the QBI deduction when they earn income above the thresholds. But there is some nuance to this, so if you want to learn more about this, just drop a comment for me below. With that said, let's make sure that you do not miss one of the largest tax deductions in the history of the tax code with write-off number two, depreciation. Now, depreciation is one of the best tax write-offs because the tax law allows you to expense it on your tax return, but it actually costs you no money out of your pocket. This is simply an additional tax write-off against any business property or assets that you already own. So think about things like any equipment, tools, machinery, furniture, computers, cameras, and even buildings, vehicles, and more. Now, by default, these types of purchases are treated as assets, not tax deductible expenses. However, depreciation allows us to write off portions of these assets every single year. For example, let's say that you are a photographer and own a $10,000 camera, and the tax code says that this camera is considered 5-year property. Well, in this case, you would be able to write off $2,000 of the amount of that camera each year for the next 5 years. But to be honest, that's just the basics. That's level one when we talk about depreciation. There are many more ways that you can calculate it. In some ways, even allow you to write off up to 100% of the property value in one given year. For example, in the same exact scenario we just went over, if you used a depreciation method called Section 179, then you would be able to expense the full cost of that camera in one given year. And that will give you a $10,000 tax write-off, saving you about $2,400 in taxes if you were in just a 24% tax bracket. And that's just one additional type of depreciation, by the way. There's bonus depreciation, double declining balance depreciation, and many other forms that may be beneficial to you when filing your tax return. So make sure you become familiar with it, or ideally the person you file with is, so that you can avoid paying taxes. And bonus depreciation specifically is something that you can use with our next big tax write-off here. So let's go ahead and talk about write-off number 3, the vehicle tax deduction. All right, so look, even if your car is in your personal name, you can write off the business use of it under your business. Therefore, if you use your vehicle in any way for your business, you can write off the portion of that use that is applicable to your trade or business. So whether you use it 100% of the time for your business or just 5% of the time for your business, you can typically write off that business use percentage with the actual expense method. For example, let's say you have $20,000 in car expenses for things like gas, oil, tires, repair and maintenance, insurance costs, licenses, and so on. And let's say you use your vehicle 50% of the time for your business. Well, in that case, you would typically be able to write off $10,000 of those expenses on your business tax return. Plus, you will also be able to write off some of the depreciation of that vehicle as well, which again will allow you to write off some of the purchase price of that vehicle every single year until it is fully expensed out. So let's say that you have a vehicle that is a 6,000 pound SUV that you bought for $60,000 in 2024. Well, under normal depreciation, you could write off about $12,000 per year. But with the bonus depreciation tax provision, you would actually be able to write off up to 60% of that same vehicle in 1 year, now giving you a $36,000 depreciation write-off instead of $12,000. So now instead of having just $20,000 in vehicle expenses, you have $56,000 in expenses, giving you about a $28,000 tax write-off that can be used on your tax return in this scenario, which would save someone about $7,000 in federal tax alone who is in the 24% tax bracket. Now, at the time of this video, bonus depreciation has been phasing out each tax year here. It is currently set to be 40% in 2025, 20% in 2026, and 0% in 2027. However, there is an expectation that the Trump administration will increase these rates. So to stay in the loop, just make sure that you are subscribed to our channel. Now, outside of writing off your actual car expenses, you can alternatively take something called the standard mileage deduction instead, which for some people may actually be more beneficial. So in 2025, this method will grant you a 70 cents deduction per business mile that you drive, or a $700 deduction per 1,000 miles that you drive for your business. With that said, let's go ahead and park this car in the garage and talk about writing off a big portion of one of your other largest expenses, your housing. And we're going to do this with write-off number 4, the home office deduction. So if you have any space in your personal residence that is exclusively used to work on your trade or business, then you likely qualify to take the home office deduction. Now, this deduction allows you to write off a portion of your total home expenses under your business. And those expenses may include your rent or mortgage interest, your property taxes, homeowner's insurance, utilities, Wi-Fi, repairs, HOA fees, and depreciation, which we've already talked a lot about. So for example, let's say you have $100,000 in total home expenses and use 10% of your home for your business. Well, in that case, you could write off $10,000 of those home expenses with the home office deduction and save thousands of dollars in taxes. Now, in order to qualify for this deduction, you must have space in your home that is exclusively used for your business, or in other words, the space should not be used for any personal purpose. Now, examples of this in the real world may include office space in your home to work on your business, even if it's just administrative tasks, or if you use your home to store inventory, like in a garage or basement or something related to that, then that space would also qualify for this deduction. But the bottom line here is that if you use any space in your home exclusively for your business, then that space could be included as part of your home office deduction. But outside of that, sometimes business requires us to travel. So let's talk about write-off number 5, the business travel deduction. So if you conduct any business during your travel, the sum of your travel expenses may be tax deductible through your business. The key here is to make sure that there is a legitimate business purpose for the travel expense. For example, let's say you spent $5,000 to go to the Bahamas with your family, which includes the cost of your airfare, lodging, and transportation expenses. Well, if you conduct no business there, then none of that expense would be tax deductible for you at all. But let's say instead the travel was for a board meeting or a business event. And let's also say that your family just so happens to be involved in your business as well. Well, in that case, you may be able to write off the full $5,000 travel expense under your business as long as there was substantial business activity conducted during each day of that business trip. So the moral of the story here is, if you want to pay less taxes, stop going on vacations and start going on business trips. Now let's talk about another big tax write-offs that sometimes can go hand in hand with business travel. Let's talk about writing off your dining expenses with write-off number 6, the business meals deduction. So look, if you incur meal expenses while discussing business, then your meal expenses may be tax deductible for you under your business. All you have to do is enjoy these meals with a business contact and discuss a business topic. It's really that simple. And then you can deduct your dining expenses at restaurants, or if you're having your meals catered or delivered to you, like using DoorDash or Uber Eats or something, then you may also write off those meal expenses as long as the meal qualifies as a business meal. So for example, let's say you have $15,000 in meal expenses. Well, if there's no business contact present and there's no business purpose for the meal, then it's simply not tax deductible. But let's say instead these meals are with one of your business partners, employees, board members, or clients. Well, in that case, the expense would be tax deductible as long as there is a legitimate business discussion taking place during that meal. Now, usually meals like this are 50% tax deductible, which in this case would allow the taxpayer in the example to write off $7,500 of their meal expenses on their business tax return. So if you're not already writing off meal expenses like this, then you may want to look into ways to qualify your meal expenses to meet the criteria of the business meals deduction and reduce your taxes. Now let's switch gears here and talk about another large expense for millions of people: healthcare, and how you can write off a large portion of these expenses with write-off number 7, the health insurance premiums deduction. So if you have health insurance and pay any portion of it, then the amount you pay can be tax deductible for you under your business. And so many people miss this easy tax write-off because they do not know that Section 162 of the tax code allows self-employed individuals to write off their health insurance premiums. It allows you to write off the full value of the premium, which may also include your spouse or children if they are also covered under the policy. So if your entire family was covered by a health insurance plan that costed you $24,000 per year, then you will be able to write off 100% of that $24,000 health insurance premium. Now, how you actually go about writing these types of expenses off will ultimately depend on your business entity, because there are different rules for different types of entities. But on the highest level, your premiums are generally tax deductible. But outside of just health insurance, some people have very large out-of-pocket medical expenses. Well, now I'm going to show you how you could write those off under your business as well with the use of write-off number 8, a medical reimbursement plan, also known as a health reimbursement arrangement. Okay, so believe it or not, your business can reimburse you for out-of-pocket medical expenses that you incur personally by simply offering this as a benefit to the employees of the business. For example, when you operate your business as a corporation, you are required to pay yourself a W-2 salary as an employee of the corporation. And that same corporation can offer a health reimbursement arrangement as a benefit to its employees. And since you would be an employee of the corporation, you would have access to this same benefit, and the corporation could reimburse you for your share of personal medical expenses. And that reimbursement would be both tax deductible for the business and tax-free to the employee who receives it, if the business is organized as a C corporation. That part is very important. And as a CPA, I have seen some of my clients with very large medical expenses personally switch over to a C Corp just to take advantage of this tax deduction alone. But the decision to switch your entity should be weighed very carefully. And for people who do not want to do this exactly, a much easier way to accomplish a similar result is to instead use write-off number 9, a health savings account. So another way to effectively write off your out-of-pocket medical and health expenses is to simply move money into an HSA. If you qualify for it, then these accounts will grant you a tax deduction for simply depositing money into it up to the maximum limits. And then you can use the money in these accounts to pay for your qualified health expenses as they come up, or invest the funds with tax-free growth while it sits in the account waiting to be used. Now, to qualify for this, you must have a high deductible health insurance plan, which most plans these days are, but you will want to double check this before you go and open an HSA. And as of 2025, the IRS defines this as a plan with a minimum deductible of $1,650 for self-only coverage or $3,300 for family coverage. And it would allow these individuals to put anywhere from $4,300 to $8,500 into their HSA for the 2025 tax year and grant them a tax deduction equal to the amount that they put in. And when they withdraw funds to pay for qualified health expenses, the funds would also come out tax-free. Now, just like you can receive a tax deduction from simply moving funds into a health savings account, you can also receive a tax deduction by simply moving money into a retirement savings account. So let's talk about write-off number 10, self-employed retirement plans. So most people plan to retire one day, and when you do, you will probably need money for it, right? So let's talk about how you can put money aside for your future retirement while reducing your taxes at the same time. So first and foremost, it helps to know the most common self-employed retirement plans to use. And those are, number one, the solo 401k, which is great for self-employed individuals who do not have employees. Or if you do have employees, then you can just use a standard 401k plan, which will allow your employees to put money towards their own retirement. And you can also set up an employer match if you choose to. Plus, there are other options available like the SEP IRA or the simple IRAs. But in my experience, these accounts do not work as well as the 401k options that we just went over. Now, in order to receive a tax deduction when you put money into these accounts, the accounts must be structured as a traditional retirement plan. Now, traditional retirement plans are great for individuals who are currently in a high tax bracket today and expect to be in a lower tax bracket when they retire. So for example, in 2025, self-employed individuals can deduct up to $70,000 of their contributions into a 401k plan, or $77,500 if they're above the age of 50. Or if they're just taking advantage of the employee deferral part of their 401k plan, then that would allow them to still put about $23,500 of their income into their 401k, or $31,000 if they're above the age of 50. With that said, let's switch gears and talk about writing off other types of large expenses, like your kids, for example, with write-off number 11, hiring your children. Okay, so instead of giving your kids money and not writing off those expenses, you can instead give them a job and write off the wages you pay them. Then they can use the money they receive to pay for the same things that you are going to pay for anyway. Except now you are writing off the expense and paying less taxes as a result. So here's how this works in a nutshell. In general, wages or compensation you pay to employees or contractors are tax deductible for the business. And when you hire any employee, you can write off the expense you incur for the service that they are providing to your business, even if they are your child. So that's the first tax benefit. The expense is tax deductible. The second major tax benefit here is that the income is usually taxed at a lower rate. And in some cases, the income is 100% tax-free to the child if they are paid less than the standard deduction. For instance, let's say you pay your child $15,000 in W-2 wages from your business, which is a $15,000 write-off for the business. Well, because the standard deduction is $15,000 in 2025, the child would be able to essentially use that deduction to wipe out all of the income that they are receiving from your business, leaving them with just $0 in income to pay tax on. And depending on your child's age and your entity structure, your child may also be exempt from payroll taxes like Social Security and Medicare. But for all of this to work, the child must do legitimate work for your business and must be paid reasonable amounts of compensation for the work that they provide to your business. So be very careful when doing something like this and think this through. But in addition to hiring your kids, you may also be able to write off some of your child care expenses with write-off number 12, setting up a dependent care assistance plan. Now, this is a benefit plan that you may offer to employees of your business, which may reimburse them for child care expenses that they incur, which in turn allow them to go to work for your business, right? Well, if your business operates as an S corporation or C corporation, you would also need to treat yourself as a W-2 employee as it relates to the services you provide to the corporation, which also in turn allows you to take advantage of this benefit as a business owner as well. So how this plan works is that it allows the business to reimburse up to $5,000 of your child care expenses for qualified employees and write off that amount from their taxes. And then in turn, those funds would be tax exempt or tax free to the employee receiving it, which could be you as long as it does not exceed $5,000. Any amount above this range will be taxable to the recipient. Now, in order for this to work, the plan must be in writing and reimbursements would have to be made in accordance to that written agreement. But overall, this is how you could legitimately write off some of your child care expenses through your business. Now, eventually, your children may have plans to pursue additional education, or you may even pursue additional education to grow your own business. And there are ways to write off those expenses as well with write-off number 13, the education expense write-off. So when exactly can you write off education expenses under your business? Well, the tax law allows you to write off 100% of these expenses if you meet all three of the following criteria. So number one, the education must be necessary to maintain or improve skills for the job position, for the business owner, or the employees of the company, which can also be family members if they work for the business, even your children if they're working for it. And number two, the education must be required by either law or by the firm. Or in other words, the business owner or employee would be unable to operate in their job position without the education. And then most importantly, number three, it must be directly related to the trade or business. Any education expense or course that is not directly related to the business is not tax deductible. So in general, when this criteria is met, you can write off various courses, seminars, conferences, and even certain degree programs to reduce your taxes. For example, I run a CPA firm, and that requires me to be a licensed CPA. Well, in order to become a licensed CPA, I am required to have various levels of education to obtain my license, and there's additional education I must have to maintain my license. Well, in that case, all of the educational expenses that I incur that are directly related to this are 100% tax deductible, no questions asked. But if any of those expenses include other things like an art course or something unrelated, then it would not be tax deductible. So that's education. Now let's talk about another big expense that you may be able to write off to grow your business, like write-off number 14, advertising. So yes, the IRS will give you a tax break for advertising your business. They want your business to grow and flourish and provide jobs for the economy, which is usually impossible without some form of advertising. So the money you spend to promote your business is 100% tax deductible. In fact, it is very common for a lot of business owners to increase the amount of money they spend on advertising to reduce their taxes. This allows them to grow their business very quickly in terms of sales, customers, employees, and so on, while offsetting that sales revenue with advertising expenses that ends up wiping out most or large portion of their income. So if your plans are to grow the business, the government will help you do that by allowing you to write off all of your advertising expenses to get there. But in addition to advertising, in order to grow our business, we typically rely on some type of technology to help us. So let's talk about write-off number 15, technology expenses. So how can we write off things like your cell phone, your computer, your tablet, or whatever device you are using right now to watch this video? Well, if you use those devices for your business, then you can generally write it off on your taxes. For example, if you use your cell phone to communicate with business contacts, to film content or shoot content, or for any other valid business purpose, then you can typically write it off as a business expense. You can write off the device itself, your service plan, and any storage you pay for, as well as any other apps you pay for that are related to your trade or business. The same applies to computers, tablets, or other software and subscriptions that you purchase to operate your trade or business. So those are 15 powerful tax write-offs. Drop a comment below and let me know what you think about them. And also, if you need immediate assistance to reduce your taxes, just apply to work with one of my CPAs today at mycpacoach.com. Thank you.